So in this video, we're going to go over the Fibonacci and then a simple pattern called the AB equals CD. But before we get into that, I want to give you guys 4 crucial letters that are essential to our trading success. And these letters are I, P, D, E. And you'll hear me mention these over and over again throughout the trading. I is for identify, P is for predict, D is for decide, and E is for execute. And in your last video, we went over how to read a price chart, how to identify bullish trends, bearish trends, periods of consolidation. We learned about support and resistance structure as well. And that whole part is basically identifying the market, being able to step into a price chart and really know what the market's doing. Are we trending? If so, which direction? Where's our next structural level at? The next thing we want to do is the P, which is predict. And this is where our Fibonacci tool is going to add on to our knowledge of market harmonics, our knowledge of knowing how to read a price action. And what our Fibonacci tool does is predict the areas of where the market is likely to retrace to and where the market is likely to extend to. So in the last video, we talked about how the market ebbs and flows and usually comes back to a structure level when we have those outside returns. Well, now when we add a Fibonacci retracement to that outside return, we can kind of narrow down and predict where price action is going to go to before we get that reversal. So where's our best opportunity to hop aboard this trend? And when we get into the Fibonacci extension tool, where is our best opportunity to take profits for a trend continuation trader or for a counter trend trader? Where's our next opportunity to try and catch the next retracement? Now for Fibonacci, you guys have probably heard lots of stories and lots of I don't want to call them myths on it, but you've heard a lot about Fibonacci, and I'm not going to get into the details of what it is exactly. You can go ahead and search that on the internet. You'll find that Fibonacci is everywhere, and petals on flowers, and seashells, and in the length of the human body. I'm just not going to get into all that. All you need to know is that the Fibonacci tool that we have on this on our charting platform, this thing works. And the first tool I want to go over is the Fibonacci retracement tool. And if we're on, let's get a blank chart. If we go to our drawing tools, Fibonacci retracement, it looks something like this. And there are 3 major levels that we use first and foremost. It's going to be the 382 retracement, so 38.2. It's going to be the 618 retracement, so 61.8, and this one is called the golden mean. This is the most powerful Fibonacci retracement. And then there's the 786, so 78.6 Fibonacci retracement. These are the 3 major Fibonacci retracements. There are also a few minor ones. There is the 50%, which we mainly use with advanced patterns. There's the 70.7, and then there's the 886, which again we'll use with some advanced patterns. So in total, there's 1, 2, 3, 4, 5, 6 main Fibonacci's that I use. Again, 38.2, 50.0, 61.8, 70.7, 78.6, and 88.6. With our major ones being the 382, the 618, and the 786. So how do we draw a Fibonacci retracement? Well, it's easy. We find the most recent swing high to our recent swing low, or vice versa. Let me give you an example. If the market puts in a move like this, an impulse leg, where we're looking at our starting point, to our initial, writing the wrong thing in there. Let's get rid of this. There we go. an initial structure low, this is called an impulse leg. Our swing high to swing low. Our sore thumb move, for those who understand that terminology. And we'll look at it and identify it on the chart. But basically, when you see the market break recent structure, so if you pretend our market was, say, doing something like this in the past, and then we get a move that breaks our most recent structure leg level, this is called an impulse leg. This move right here. We'll thicken this up some. How we use our Fibonacci retracement tool is by taking the start of our impulse leg. So in this case, the swing high right here, our starting point, down to wherever this move ends. So whenever this move starts to retrace and price action starts to come back up, starting our outside return, this is where we drag our Fibonacci to. So again, we take our Fibonacci retracement tool, we go from swing high, the starting point of our impulse leg, down to the move completion, our swing low. And you'll see price action retrace to the 382, 618, 786, 886. But again, right now you need to worry about how do I draw this Fibonacci in. If we're looking vice versa, if we're looking in, say, a bullish trend, let's say the market does something like this. We consolidate down here, we're pushing left and right. Boom, market's not really doing anything. And then we get a big move up. Creating what? A new starting point. Breaking structure to the high side this time. Giving us an initial structure high. This is our new impulse leg. How will we use the Fibonacci retracement tool on this? Well, we go from our starting point, so our swing low, to our swing high. And this is how we measure the level of our retracements. So let's take a look at this on an actual price chart. Okay. So looking right here, the market is consolidating. We're going sideways. We're not really breaking any structure level. And then finally, right here, the market decides to break through, breaking recent structure, and push down to this point right here. So this is going to be our starting point. This is going to end up being our initial structure low. And this move from this swing high to this swing low is going to be called our impulse leg. Now, as soon as we see the market start to retrace, so as soon as it looks like this move has ended, that's when we bring our Fibonacci tool on. We take our Fibonacci retracement tool. We go from swing high to swing low. And boom, you can see price action comes right back into the 382. Let's look at our next leg. Again, swing high to swing low. So this time it's our outside return. Down to our new structure low. And what we want to do here is take our Fibonacci retracement tool. Let me delete this last one. And we measure out our impulse leg. So our swing high, which starts at our outside return, down to our swing low, which is our new structure low. Boom. You can see price action comes right to the 786. Now again, At this point, I don't want you to worry about. You're probably asking yourself, well, Keel, how do I know which Fibonacci is going to hit? Don't worry about that right now. Right now, just once you get used to drawing and knowing how to use the tool. So I would recommend we're gonna go through a few more, but I recommend bringing up a chart of your own. Pausing this tape every once in a while and just start identifying these impulse legs again, swing highs to swing lows, and using your Fibonacci tool, drawing it from your starting point to your low, your swing high to your low. Let's follow the market on. See if we can get a bullish example. And it's telling me we can even look right here. So let's call this our starting point down here. Let's steal this. And we'll call this our initial structure high. This is going to be our first move, starting point to initial structure high. So how we would use our Fibonacci retracement tool in a bullish trend would be taking it this time from our swing low to our swing high. You can see price action retraces for our outside return. We come to the 382. We don't quite break above this high yet, and we come a little bit lower and retest the 618 before the market resumes and eventually shoots up. So now we have our outside return starting right here. And you can see the move is made to a new structure high, giving us another impulse leg. Same thing. We take our Fibonacci retracement tool. We go from our swing low up to our swing high. And what do you know? Price action comes right to the 382. So you can see price action hits this level over and over again. And we can go to any point on these charts. I just didn't pick out random areas. We can go to any swing low to swing high, or swing high to swing low and draw them on. Look at this. Swing low to swing high. Price action comes right into a 382. Let's take even this swing low to swing high. Price action reverses or retraces. Boom, 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 right to a 382. Everywhere. This time, right above a 618. Didn't quite get there. Our next move, swing low to swing high. Again, right at a 382. And it doesn't go exactly at it, but you can see in that area. Swing low to swing high. 382 retracement. And finally, this bearish one, we'll take swing high to swing low. Where do we come to? Right to a 382 retracement. So you're asking yourself, well, how do I know which one to pick? And now we'll get into that. By this point, you should have at least some sort of belief by the example I just gave you that these Fibonacci tools work. They're not just random numbers that are made up and you should trade each one of them. You should believe that the market indeed does reverse at these numbers. I don't know if it's a psychological thing. I don't know if it's a mathematical thing. I don't get into all that. I know the tool works. I know the market respects these zones. So the question is, how do we use this in our trading? Well, if you remember in our last lesson, we talked about when the market's trending, we have our starting point to our initial low, our initial structure low. We then have an outside return. And then we usually create, if we're in trend, we'll create a new structure low. Now that next outside return, where does it come to? A lot of times you'll see it come right to that previous structure level. Look left, structure leaves clues. Structure acts like a magnet. This is where we use our Fibonacci for confirmation. So you can see right here, our previous structure level is going to be right here. The market was in some sort of a bullish trend. You can see a previous outside return right here. We then push up higher. And then what happens? We break lower, reversing the trend. So our last previous area of structure was right in this area, this red zone. So as a trader, following this trend, we're expecting not only an outside return at this level eventually, but when we get that outside return, we should be predicting that the outside return is probably going to complete somewhere around this previous structure. Remember, look left, structure leaves clues. Now, probably isn't a good enough reason to get into the trade. You know, if I traded every situation where I'm saying to myself, probably, I would probably be broke by now. So we look for confirmation. One way of finding that confirmation is seeing if there's any confluence between our structure level and a Fibonacci retracement. So I'll take my Fibonacci retracement tool, just like before, swing high to swing low of this impulse leg, and what do you know? I'll see that my 382 Fibonacci retracement, thicken this up for you some, my 382 Fibonacci retracement comes in at the same level as this structure, giving me more confirmation that this is going to be a key level in the market. Now again, I'm not just trading it right away as soon as it gets there. We'll go over trading techniques as this course goes on. But the first thing we want to do is identify the market, what's going on. Impulse leg, swing high to swing low. There should be a reversal in trend. And then we want to predict what's going to happen next. Well, we just got an impulse leg, a swing high to swing low, a starting point to an initial structure low. Akil taught me that after that, we should look for an outside return. Well, if this outside return is going to occur, where is it going to go to? All right, look left, structure leaves clues. Here's my structure level looking left. Let me try bringing on that Fibonacci retracement tool he talked about. What do you know? A 3D2 lines up right with that structure level. 2 is better than 1. Again, not telling you to go out and trade this right away. Don't go setting a limit order right at this level and entering every trade you see. But you can start predicting where the market is going to reverse at. Let's scroll through and see if we can see more examples. Right here, small one. You see the market pushes up, swing low to swing high. We then retrace. We actually retrace right to structure in here as well. That wasn't the example I was going to give you, but we have our structure level right here. This is our previous swing high, right? We can call this our starting point. Make sure I'm spelling this stuff right. Starting point to initial swing high. ISH, initial structure high, I'm sorry. We get our outside return. And after we break and close above this level, this gives us what? New structure high. Put our thinking caps on. After we get a new structure high, what do we expect? Another outside return, right? Where is that outside return going to come to? Probably our previous structure high level. So we create a zone right here. Here's our previous structure high. There's a good chance that our outside return will come to this level. Let me use my Fibonacci retracement tool. Let me take my swing low to my swing high. What do you know? A 382 right at that level. No coincidence that the market decides to give us our outside return right to that level before retracing and swinging higher. Let's see if we can get a few more examples of this. Again, you'll see this all over the place. Let's clean up the chart some. See if we can get something other than a 382. All right, even let's take a bigger trade. And this may be a 382 as well, but we have our starting point down here. We have our impulse leg, swing low to swing high. And if you're having problems identifying this impulse leg, scrunch the chart up real tight and it should stand out for you. You can see them all over the place. Look at this. That's a little trick for you guys. So we have our starting point, our initial structure high. We then get our outside return. Wasn't the example I was giving you, but look where our outside return comes to. Right to previous structure. Let's see if there's a Fibonacci in there. Right close to a 618. Probably going to be at our minor Fibonacci, which is our 50%. Right on that 50%. But again, that's not the example I wanted to give you guys. But you can see it works. So we have our starting point, our initial structure high. We have our outside return. The market then pushes up, giving us what? A new structure high. We can now predict where the market is going to retrace to. What do we have right here? This is now our previous structure high. We know that an outside return often wants to test this level. Again, structure leaves clues. Structure acts like a magnet. Price action wants to come to this zone. Can we get any more confirmation at this zone? Well, let's take our Fibonacci retracement tool from our swing low to our swing high. And you'll see that there's going to be a 382 right at that level. 382 right at that level, right at the wicks of this high. And if we bring in a 50% retracement, one of our minor points, it's going to be a little bit lower. And we have a nice zone where you see the market reverses. And it's crucial, guys. You got to remember, the market doesn't always reverse on a dime. In fact, it rarely does. So if we draw out a Fibonacci retracement or even a structure level, and we make a prediction, the market usually doesn't just hit that number and run away right off the bat. We'll see it complete a little higher than the structure level or Fibonacci level. We'll see it complete a little lower. And those are the areas where traders get into a lot of trouble. When we get into, again, entry techniques and placing stops and stuff like that, it's crucial that we give ourselves some room to breathe, a buffer zone. Because a lot of times you'll see traders place an order right at this 382. They'll say, man, this is it. It lines up right at structure. Akil said, when you get these two things, it's a good buy. And what you'll notice is they'll put stops right below, and the market will come stop them out before going on its way. So again, that's later on, but you want to be aware of that. It's you want to create what I call a kill zone, or what Carney refers to as a potential reversal zone. And when the market gets to that potential reversal zone, that's when we start using our techniques to enter the trade and hop aboard. So that should be pretty clear about Fibonacci retracements. Again, I recommend pausing this tape, bringing up a chart, start drawing swing highs to swing lows to swing highs, outside returns, and start practicing to draw these Fibonacci retracements on. And after you're done, then we'll talk about the next tool, which is our Fibonacci extension tool. Okay, so the next tool we want to talk about is the Fibonacci extension tool. And as the Fibonacci retracement tool was used to predict where the market is going to complete its outside return, the Fibonacci extension tool is used to predict where the market is most likely to go once it extends. So after the market puts in our initial structure high, our outside return, we expect another new structure high if this trend is going to continue. Now we know our Fibonacci retracement tool, taking our swing low to swing high of our impulse leg, predicts where the market's going to retrace to. If we want to know where our next structure high is going to complete, that's when we bring in our Fibonacci extension tool. And for the Fibonacci extension tool, there are three main levels. There's the 127, so 127.2 Fibonacci extension, and there's the 1618, so the 161.8 Fibonacci extension. Those are our two main extensions. We do have one minor one, and I'll bring that in right here, and that's going to be the 1414, so the 141.4. So again, the three levels of Fibonacci extensions we want to concern ourselves with is the 127.2, the 1414, which is our minor, and the 1618. So We measure our Fibonacci extension very similarly as we do our Fibonacci retracement. We're still looking at the same impulse leg, swing low to swing high. However, with this tool, and it may differ some depending on your charting package, we want to take it from the swing low of the move to the swing high, so our starting point to our initial structure high, and then we want to bring it back down to our swing low. And what it's going to do is predict a Fibonacci extension level of where the market is likely to extend to. And as we see the market push up, as we see it break past our previous structure high, giving us a higher high, higher close, we'll see the market come to one of these levels before it starts to retrace once again. So this is important in predicting profit targets. Once we learn how to efficiently enter a trade at this point, the obvious question is, well, where do I put my stops first and foremost? And where do I take my targets? Now, stops, we always want to put it below structure. So if we're trading this trade right now, and let's say the market was doing this beforehand, our stops need to go below our previous structure lows. So in this case, our starting point. This gives us a risk of about this much. Let's go ahead and color this in red to make it clear. Red is bad. Red is risk. By using our Fibonacci extension tool, if we're trading this trade like a trend continuation trader, we can expect our trend to continue again to at least the 127 and maybe even the 1618. And what this does is set up a profit level. So it sets up a level for where we can take our first position out, where we can take our second position out. Basically where we can exit the trade. Again, I don't want you to get too concerned right now on exits and entries. We have plenty of time to go over that. But understand that the Fibonacci extension tool, again, taken from our swing low to our swing high and back down, the same leg as our Fibonacci retracement, this is how we predict where the market's likely to go next. And if we were to look at this on bearish trend, we have our starting point right here. We have our initial swing low, our initial structure low here. We have our outside return. We would then take our Fibonacci extension tool. We'll go from our starting point to our initial swing low, our initial structure low, so our swing high to swing low. Back up, and you can see it brings in our 127 prediction and our 1618 prediction. Just like with the retracement, when we line these levels up with previous levels of structure, it allows us to make a high probability prediction on where the market is likely to extend to, and for counter trend traders, where the market is likely to go before it runs out of steam and we get another pullback or another outside return. So let's go back to the chart, start drawing these things on so you guys believe me. We have a beautiful impulse leg right here in front of us. We have our swing low to swing high. You can see we have our retracement right here. And let's see, if I take my Fibonacci extension tool, swing low to swing high, and back down, if I draw a line right here, look at that. Where does price action go to once it extends? Right to my 127.2. If I look at this recent move right here, swing low to swing high. Bringing my Fibonacci extension tool from our starting point to our swing high and back down. Where does this market come to? Right to our 127 extension. We could take any example of this. Let's take this move right here. Swing low to swing high. Fibonacci extension, swing low to swing high. Back down. This time, where do we come to? Boom. Right to our 161.8 Fibonacci extension. Let's look at a bearish move now. Market consolidates up here. Looks like it puts in an advanced pattern actually. Finally, we get our impulse leg to the downside. Remember, we break this structure level. So we have our impulse leg right here, our starting point to our initial structure low. We can bring in our Fibonacci extension tool, swing high to swing low, back up. Look where price action comes to. Right to that 161.8. If we look left, what do you know? Previous level of structure. Look left, structure leaves clues. And you can see, even at our 127, looking left, we hit a previous structure level. We actually hit it once, twice. Although price action doesn't fully reverse right here, you can see price action spikes down. This level is respected, and then we get a brief pop right back up. Let's see if we can find another bearish one. Euro's been bullish for so long. Let's take a look at this one. Price action breaks previous structure, so we have our impulse leg, starting point to our new structure low, or our initial structure low. Let's bring in my Fibonacci extension tool, swing high, swing low, right back up. 1618 extension, right there. Swing low to swing high. Bring in our Fibonacci extension tool, swing low to swing high. This one's going to come right into, boom, our 1618 extension. So the next question you're asking yourself is there anything else I can use to kind of predict which one it's going to extend to? I've seen some that extended to the 127.2. I've seen others that extended to the 1618. What else can we use to predict that level? And again, we can zoom out, or scrunch up our charts, I guess you can say. Look for previous structure levels at that level. Again, look left, structure leaves clues. You can see structure is hit here. Structure is hit here. But we also know that the market likes to move harmonically. And this is where our AB equals CD pattern comes into play. We know that the market likes to put in what we call equal measure moves. So if our initial swing low to swing high is like this, and we get an outside return here, usually if the market's moving harmonically, the next move will be an equal length move. And again, this is called an ABCD pattern. We can start to label these moves. Our initial leg is going to be our A to our B. Our retracement leg is going to be our C leg. And then our completion is going to become our D. And we call it the AB equals CD, again, because the AB leg should be equal length of the CD leg. So again, when the market's moving harmonically, when the market is trending, you'll see these equal measured moves play out. And this can be a very profitable pattern if traded the right way. So let's take a look at a chart. We have our initial leg right here. We have our A leg. Swing low to swing high. This is going to be our B. We then get our outside return. This is going to be our B to C move. In order to predict our D completion, what we can do is take our A to B move, copy and paste that, plug that onto our C move down here, and what do you know? Look at that. Price action comes right to that level before retracing. And again, it's a zone. You can see it spikes a little bit above, doesn't complete exactly at that level, but it's within that zone. We can see another one right here. This time we have our A to B being our swing high to swing low. So our A leg up here, our B leg right here. We have a small retracement up here. giving us our C leg. And we know our D is going to be somewhere down here. And if we take this, if we copy and paste it, look at that. This candle comes exactly to our D leg. Let's draw another one. And these don't always complete, guys. They don't always complete. But you'll see, again, when the market is moving very well harmonically, you'll see some type of retracement at these levels. Swing low to swing high, A to B. Our outside return, drew that a little sloppy, is going to be our C leg. Let's copy and paste this. See if we can predict a decompletion. Decompletion right here. What does the market do? Retrace. And again, you see this over and over again. This one looks like it may be a little short. Yep, that one's going to be a little short. We don't quite get down to it. But if we scroll through the markets, scrunch up our charts, look at this. Swing high to swing low right here. This is going to be a bigger one. So our initial A leg to our B leg, our swing high to swing low. We get a deep retracement this time, giving us a C leg. Looks like a 786 to me. Yep, right to a 786 Fibonacci retracement. The first thing we learned about in this session. And then how do we know where our D is going to complete at? Well, we take our A to B move. We copy and paste it. Attach that to our C leg. And what do you know? Decompletion right in this level. Over and over again. You can see them all over the place. A to B. B to C. Copy and paste. This time we come up a little bit short, but you can see right in this general zone. And here's a great example of one in a live market. We have our initial swing low to swing high right here. Now, right now we've been consolidating. You know, we don't really have a true break and close above structure until recently. So we have our initial swing high to or swing low to swing high. Excuse me. We can measure this. Our A to our B leg. Now we don't have a previous structure level. We have some structure back here, actually. You can see price action comes right into that level. We don't have a previous retracement in this A to B leg, but looking left, structure leaves clues. And we have structure right in this level. And you can see our outside return, where does it come to? Our C leg, right into that structure level. If I were to bring a what on? Yep, Fibonacci retracement tool from our A leg up to our B leg. You can see we come right between a 382 and we just nip a 50% retracement for our reversal zone. Now the next thing I want to do is predict where is this market going to go next. What do I have right here? Well, I have a higher high, higher close, right? This candle breaks and closes above our previous structure high right here at our B leg. So my prediction is that the market is going to go higher. We're going to start this bullish trend, but where is it likely to go to? Well, that's when I bring my Fibonacci retracement tool on. I'll take it from my swing low to swing high, my A leg to my B leg, back down, and you can see I have a 127 right here, which comes in that structure. Look left, structure leaves clues. Now I have a 1618 retracement, or extension, excuse me, up there, which, let's see if it comes into structure at all. I've got too much stuff drawn in this chart. Comes into not much structure. We have a little nip right here, and we have a little nip right here. And actually, we have another nip right here. So we do have some structure at this level. I think I drew these in wrong. Hold on. The lower one. All right. So we have 1, 2. You can see we consolidate right down here in this level for 3, and then 4 right there. So we have some structure there as well. What lastly do I want to do? Well, I want to make my D prediction. Where's our D leg likely to go to? So I'll go ahead and copy my A to B move, or I'll draw a new one on. A to B. Drag that onto my C leg. And you'll see my ABCD pattern is going to complete right here in the middle, right near our minor Fibonacci extension, which is going to be our 1414. And again, not exactly at it, but right in that zone. So I have two levels to predict where the market's going to reverse at. My first level is going to be right here. This is our level of previous structure. My next level will be this ABCD pattern completion and this 1414. So a little zone in between this area. And let's look left and see if there's any structure there. Again, gotta scrunch up the chart some. You can see structure right here, structure right here. I don't have a lot of data up here, but structure right here. You can see structure does hit that level. So there are two zones where I'm making, gotta learn how to navigate these charts better. There are two zones where I'm making my prediction. The first is this 127, because this is where recent structure comes in. If I don't get an entry signal at this zone, I'll look for my next zone, which is going to be my ABCD pattern completion at this 1414 Fibonacci extension. Lastly, if I don't get an entry signal at this point, I'll look for my 1618 Fibonacci extension as sort of my last chance area. Now again, this is why it's important that we will get into different entry techniques, and you're probably asking yourself, well, you just predicted 3 levels. Well, how do I know which one to enter at? And the way I teach trading, we're not going to do aggressive entries at this level, meaning I'm not just going to fire up a limit order and say, well, I'm going to sell it right here. We start to look for confirmation, and as we go on this training program, you'll learn different techniques like double tops and RSI diversions and lower low, lower close candlestick entries. And when we get to these kill zones, that's when we'll really dig deep into the chart. We'll really dig deep into the chart and look for a reason for entry as the price action gets to that zone. And if we get a reason for entry, well, we'll build a case and either take the trade or wait into the higher probability area. But for right now, we just want to worry about predicting where the market's going to go and learning how to use that Fibonacci retracement tool, how to use that Fibonacci extension tool, and how to use that ABCD pattern completion to predict the areas that the market is likely to go next. And remember, all of these tools should be joined together with structure levels. Structure leaves clues. We know that the market wants to go there. We know that price action is gravitated towards these levels. So when we get an extension, when we get a retracement, or when we get a ABCD pattern completion that lines up with structure, there's a high probability chance that we're going to see some type of reaction at that level. So lastly, I want to share a quick chart with you, and you'll see this in your PDF file. That's kind of a cheat sheet for our ABCD pattern and Fibonacci extensions and Fibonacci retracements. And because they're all numbers based, what you'll notice is that the level of the Fibonacci retracement, so the level that our outside return comes to, will line up with a harmonic move at a specific Fibonacci extension level. So as you can see, we have our initial A to B leg. If that outside return comes to a 382, then an equal measured move, so an equaled ABCD pattern, should extend to the 1618 Fibonacci extension. If that B leg, or if that outside return, is a little deeper, say we go down to the 618, then we should expect price action to extend to an ABCD pattern at the 1414 extension. Lastly, if we get a deep outside return that comes down to the 786, then we should expect price action to extend to the 127.2 Fibonacci extension if we have an equal harmonic move. Now again, when you're looking at the markets live, these numbers aren't going to be exact. Price action will sometimes dip a little bit before the 382, dip a little bit after the 618, and we're not going to line up exactly on these zones, but this should give you an idea of where to expect the market to go if it's moving very harmonically. So, as always, your action item, you want to load up your own charts. You guys already know about trends. You know how to draw in trends. Start identifying these impulse legs. Remember, swing lows to swing highs to swing lows, and start measuring these Fibonacci's out on there. Take your Fibonacci retracement tool and draw a level. Gain confidence that the market indeed retraces to one of these fib levels. Next, you want to see how do these fib levels line up with previous structure. So take your chart, draw it out to that fib level, and then scrunch it up and see how many times in the past does the market hit that zone. If I'm looking at price action right here and I see structure here, how many times does the market hit that zone? Well, I see it once, twice, 3 times, 4 times. After that, start working on that Fibonacci extension tool. So take that same impulse leg, that same swing low to swing high or swing high to swing low, draw that Fibonacci extension in, and again, start gaining confidence in the market's ability to hit these Fibonacci extensions. Boom, right to the 1414. Lastly, the ABCD pattern. Draw a line on the initial move. Take that line, copy and paste it, tag it onto the retracement, and see if you can start identifying these equal measure moves. Again, all of these tools are used to help predict price action in the market. The first lesson, how to read a price chart, learning trends, that's all about identification. This lesson is all about prediction. After that, there's only 2 things left to know: deciding where we want to get involved in the market, and then executing the trade. So again, practice makes perfect. Take out a chart, run through this over and over again before moving on to the next lesson. Make sure you have a really, really good understanding of this. These levels should be able to pop out to you. And in the next lesson, we're going to go ahead and talk about double tops, double bottoms, and some entry techniques so you can start involving yourself in these type of trades.